morning to you and welcome. This is Money Monday, your go-to show for financial tips, wisdom, and also we give you strategies as a business person so that you can you can grow wealth and success itself. So whether you're a day-to-day person aspire to have a business of your own or become this great entrepreneur, you are a business person and you're looking for strategies on how you can grow your business, you are in the right place. My name is Angela Kavete and welcome. Don't forget you can interact with us on our social media handles, that is on Facebook and YouTube at Mizpah Tv Kenya. Hashtag is Money Monday. Tell us, where are you watching us from? So that is Richard Branson once said, never take your eyes off the cash flow because it is the lifeblood of business. And that's why today we're talking about that is cash flow management. Cash flow management. And according to statistics, they say that 82% of business failures are attributed to poor cash flow management or inability to manage liquidity. That is according to statistics. And then they also say that more than 60% of businesses that fail are profitable. Okay, so probably I don't know if they're trying to bring this aspect here. Making more profit without cash flow management is deadly. And actually, I've remembered I was reading a book by Robert Kiyosaki, and he was saying that making more money will not solve your problems if cash flow management is not managed well. Okay, and still they say that for small businesses, over 30% exit within first 2 years and nearly half exit within the 5 years. Could cash flow management be part of the reason as to why they exit? And that's why today we're talking about this interesting topic, that is cash flow management. And today in studio I'm joined with an amazing guest full of experience when it comes to the world of finance and cash flow management, and still he is a financial consultant. His name is CPA Kitur. A very good morning to you.
Good morning, Angela.
How are you doing?
I'm doing good.
And the last time you were here we talked about budgeting. Today we're talking about that is cash flow management, and we are honored to have you today on the show.
Thank you.
And talking about cash flow management, actually I remembered a scenario that I want to share with you today. Let me give this scenario. I have these friends of mine, okay? When we go out, one of them sticks to the budget, and that person, she's like, oh, Mimi, come on, 1,000, it's 1,000. And then there's this other friend who is like, because we're out, let's stretch our finances. Kuna mwingine mwenye atasema, because we are out, let's spend the money, okay? We only go out once in a while. What do you have to say about, and let's circle it back to the world of cash flow management, okay? On that perspective, what would you say about it?
Yeah, thank you, Angela, for that scenario that you have mentioned about the two friends. And to a certain extent, we may say both are right.
Both are right?
Probably one or even one is wrong. Because this person you are talking of stretching the budget, probably he or she had budgeted, had given some buffers to. That is like you had estimated it will cost you, let's say 30,000, but the person made a buffer of let's say 10,000 or let's say 20,000. So he or she had budgeted. There is an additional, say that in case there are emerging issues, then he or she can cover that. However, if it is something that was not budgeted for, that was not included or prepared for, then it becomes wrong when you have a stretch, unless there are urgent or emerging issues which are necessary. Because cash flow management, basically you are managing the inflow and the outflow. And managing the inflow and outflow, you are estimating, if let's say you are doing a cash management for a period of let's say 1 month or let's say 2 months, then you are looking at your expected inflows versus your expected outflow, and in whatever, whether it's you want to purchase, let's say, an asset in 2 months, in 1 month, you are paying salaries, you are paying government statutory deductions, so you have included you have estimated that you are going to pay. So that if failure to stick to that, you may find yourself probably even becoming late in payment of some priority issues, like when you fail to manage your cash flow, and there are some statutory amounts which you have to pay, like for a business, we are talking of such statutory deductions like share taxes, and SSF. So failure to which to pay within the time, there will be penalty, meaning there will be more in outflow which you are expected to pay, was there are penalties tied to that, and that is as a result of you failing to manage your cash flow.
Okay, I love the way you've brought it out, and I would love you to elaborate. What is the difference between, probably the people are not understanding, what do you mean by when you say outflow and cash that is inflow?
Oh, thank you, Angela. I must have used big terms. When you say outflow, outflow, we are talking of money moving out.
Okay.
So if it's a business, money moving out in terms of you are paying, let's say, expenses like salaries, rent, taxes, theater statutory deductions. You are purchasing, let's say, an asset like computer for the business. All those are money which are moving out of the business. That is what I call outflow. Then now we have the inflow, the money you are receiving from the business activities you are doing. If you are involved in, let's say, retail or wholesale business where you are selling consumer goods, then we have money coming in as a result of sale of those consumer goods. Even a loan, if we expect to receive a loan, then that becomes an inflow when you receive. So inflows are all the money coming into the business, then outflow are the money moving out of the business. So failure to manage the two may result in because you may have a inflow not matching with outflow because of you failing to manage the cash flow of the business, and they are negative in both sides, because if you fail to manage inflows, then it means you are likely to have let's say inflow which are less than the outflow, and some of the outflows which you are expected to pay as the tutor or priority which you cannot kuhepa in terms of payment of them, like even a loan falling due within a period. So if you fail to manage the inflow to match with the outflow, then you may find yourself being in trouble. Or even the inflow, the coming in money coming into the business, a lot of money coming into the business without matching with the outflow, then it means you'll have idle cash which are lying in the business, and you know the risks which are being faced by cash flow. That is cash lying in the business. It could be theft, it could be even loss of the interest you could have and if you had invested in money generating investments.
Okay.
Yeah.
And now, what can businesses do, because you've mentioned it on a perspective of the people who are in the world of entrepreneurship, to make sure there is a strike between that is the inflow and the outflow? Yeah,
it involves a lot of techniques, but it depends on the extent of the magnitude of the business, or even the payments or inflows and outflows you are dealing with. Like for an individual who may be just managing cash flow for, let's say, 1 week. Was assuming, Angela, you are going out for that the one you had mentioned. You are going out, let's say, to Nyahururu kind of, and then you estimate your cost will be around 20,000. Then that one you can just write, or you can just have it even in your mind. You are saying transport is this much. If you are going to a hotel, the estimated cost of this hotel is this much. So your budget is around, let's say, 20,000. You have even included the activities you are likely to undertake there and the related cost. So if it's on a low scale, then even just indicating is okay. But in higher senses, in magnitude, like even for corporates or even individual who is dealing with a lot of transactions, he or she can use technology. Technology is playing a role where you do technology that will assist you in managing your cash flow. So either I was supposed to mention something like budget to match with it. Budget, you do a budget, a plan, let's say, for an entire year, where you are looking at the incomes you are likely to earn and the expenditure you are likely to incur.
Okay.
So that now, that budget becomes also a technique where you are managing your cash flow, because if you had budgeted, let's say in August, that you are going to purchase a motor vehicle kind of. So as you move towards that August, then you are even looking at the cash that you have. Do I have enough cash? Will I be forced to, let's say, look for loan, an inflow that will now match with that outflow that you want to purchase that asset? So it's a, so you have used budgeting, you have used technology, you haven't just used you are recording, or just you are mindful if the magnitude is at a lower scale. I was looking at Angela, which is also part of cash management. I was watching an interview by Citizen TV with CS Bahati. He was talking about making a payment of loan, a loan which was due to be paid in 2028, and I think 2028, and there is one to be paid in 2032. They have started paying that because of what? They want to manage cash outflow by 2028. I think there are some loans which are following up each other, and the government may fail to pay. You remember, if you have loans, various kind of loans falling due almost at the same time, then you may likely to even fail to pay when they fall due. So if you are in a position probably to discharge some even before you reach that time, you can discharge if you don't have various obligations as of now. That is still part of cash management, the forecasting.
I love that. And you've mentioned a certain kind of a strategy that is you've said that is accounting, budgeting, and bookkeeping. And let's say, for example, there is a company or a corporate person mwenye ametumia ya 1 year, okay, or a business. For how long are they supposed to take so that they can review it?
Cash flow management. Cash flow management, it's basically flexible because of emerging issues, which was you may have included unexpected inflow from let's say customers you have sold goods on credit. We call them receivables or debtors. You had said this debtor promised to pay, let's say in August, and we are moving towards August. The person fails to pay or even pays half, then that now affects the business.
And how are you supposed to handle that? Because I believe sometimes it happens.
We do flexible kind of. Also, it reaches an extent where you are forced to now look at the priority areas. Some, like I was telling you about statutory deductions or even loans, where when you fail to pay within a given period, if it moves to the following month, penalties will be charged on the amount that is due. So it reaches an extent now you say, I am facing a challenge in terms of inflow. I had estimated to receive this amount of money, but I have received probably even less, let's say 50%. I was to pay this and this. I was even to purchase a motor vehicle. But now, because of the situation that we are in, you decide to do away or even postpone other expenditures or payments you are supposed to pay. That will at least easen the stress kind of, and you have made your budget to be flexible, or your cash flow management to be flexible. You have elected to go with reality in the ground. You had said outflow is this, but because of issues to do with inflow, then you are here to prioritize and pay ones which probably they may be having penalties, or even you do away with those which may not be necessary, or you can postpone. Like you had let's say Angela, you had budgeted to go to Dubai for Christmas, and now the Christmas is coming by, and you don't have enough cash flow, and probably there is a loan you are repaying. So you may say, can I defer this Christmas, this visit to Dubai to, let's say, the following year or early next year?
It's okay to postpone, right?
Yeah, it's okay. So now you have flexed your cash management. Yeah, that is in line with the question you're asking.
Oh, I love that. And let me connect that what you have said with this question. Then this goes to the small SMEs. How do you survive a dry spell that is of 2 to 3 months? Okay, with a minimal revenue.
With let's say the inflow far less than we had expected. That is what I was saying. You now need to prioritize areas which you are supposed to pay. because remember there are some which you fail to pay, probably even the business can have some legal implication in terms of continuity of the business, the going concern. So you look at the expenditures which you are expected to pay and how you can even defer some expenditures or payment.
Okay.
So that will assist the business in terms of, like when we had COVID, COVID it really affected our inflows. Like for, let's say, I remember training institutions like universities, like colleges. What they did as part of that cash flow management, they had probably to use other techniques like online learning. With online learning, they were able to reduce the costs, operating costs in terms of providing, let's say, that training or that education. So that you can have a lecturer, one lecturer, could be part-time lecturer, teaching online, let's say a course which was supposed to be taught in the various campuses of that university, but now it's one lecturer doing it online, and that will have reduced drastically the costs, and they were still able to manage the cash flows they had.
Okay. And let's check out some of the mistakes. According to you and your area of expertise, what are the common mistakes that many businesses make when it comes to that is forecasting cash flow?
A common mistake, Angela, which I say, is basically failure even to plan.
Planning.
Yeah, planning. And one of it is budgeting, where you just go along the way, you decide to purchase an item or pay an expenditure which was not included. You had mentioned that we will still revolve around the scenario you had mentioned. That friend of yours, you have gone for an out, then she pays. Or she incurs an expenditure far beyond what she had budgeted for. Then it means now that will affect he or she likely even to fail to meet the obligations which were expected to have been paid. Yeah.
So basically, are there more mistakes that you think they make?
Yeah, more mistakes are one of it. Another one is basically recording. Because when you fail to, without recording, what you fail to record, or even to include all the expected payments that you are expected to pay. You just move on haphazardly. In money coming in, you make a payment, and some of the payments may be even out of the business. It may even be non-priority areas that will affect the business in terms of management of the cash. Others is even failure to manage the aspect of inflows. Like we may talk about receivables that I was telling you. You are selling on credit, and then you fail to manage that inflow. Yeah. Somebody may, you know, Angela, sometimes somebody may even fail to follow up on credit sales they have made.
That is a mistake?
Yeah, it's a mistake. Because you have failed to manage. Because management of receivables is a component of cash flow management. You are failing to manage that receivables, the payment of it, that will affect the inflow at that time. You also fail to manage, let's say, payables, like creditors. You are getting goods from suppliers. Let's say you are dealing with retail business, you are getting goods or services from suppliers, then you fail to manage when are you expected to pay. So it becomes due, but now you have failed to pay within the due period. That will affect your business.
And in addition to what you have said, can you say that even giving more credit for certain season can also affect cash flow management, can it?
Giving
credit, goods on credit.
It happens now when in a situation where you are giving credit, and then there are customers who are likely to just purchase on cash. So that again narrow down to management of that credit. Because you find for businesses, as you give credit, you also need to know there are customers who are paying cash. Just imagine, let me just use the ordinary example. Assuming you are selling milk and you are selling 20 liters, and then somebody comes in, he or she wants to purchase the 20 liters on credit. So if you sell the 20 liters on credit, then it means the stock has been sold. So in that case, you'll have sales. Let's say sale over the 20 liters, but there is no cash. Yeah. And that comes down to Angela, the difference between profit and now cash.
Okay.
So remember, when you are doing your profit and loss account, you are looking at sales and expenditure, the expenses you have incurred. So whether you have sold on credit or cash or whatever, that is still recognized as a sale. Whether you have the cash or you don't have the cash, it's a sale. So you have sold the 20 liters probably at, let's say, 100 shillings each. That is around now, how much? That is around 2,000 shillings. So your sales are 2,000 shillings, but you don't have cash because it was sold on credit.
Okay.
So you have a profit of 2,000. Of course, minus my operating expenses, let's say, of 1,500. So you'll have a profit of, let's say, 500, but you don't have cash. So that is a failure in which you fail to manage now the credit itself.
Okay, so let's hold on now, Apo Kidogo. We go for a short break. Then when you come back, you can help us understand more, and also you can talk about that is medium-sized business and the corporate managers on how they can consolidate that is cash flow across the business units that they have. For our viewers, we're going for a short break, but you can interact with us on our social media handles, that is on Facebook and YouTube at Mizpah TV Kenya. Tell me, what have you learned, what have you taken, and what are you going to apply practically in your business? That is on 0799 200 100. Stay tuned. We'll be right back after the short break. And welcome back. This is Money Monday, where you go to show for financial tips, insights, whether you're a day-to-day person aspiring to have a business of your own. You give the strategies on how you can become a better person and also financially independent. Well, today talking about that is cash flow management, and in the first session, at least, our guest ametudia kuelewa what we mean by this term that we call that is cash flow management, the strategies, the mistakes that you make as a day-to-day person, as a business person when it comes to cash flow management. Welcome back, sir. And his name is CPA Kitur. He's a financial consultant, and I would love you to help us. I would love to hear your perspective. Robert Kiyosaki was saying that making more money will not solve your problem if cash flow management is your problem. Do you agree with that?
Yeah. Making more
money will not solve your problems if cash flow management is your problem. Do you agree with that? And why do you agree with that?
Yeah. That is a nice quote from Robert Kiyosaki. Basically, it trickles down to what I was saying, inflows versus outflow. Irrespective of how much you are receiving, then how you are spending what you are receiving becomes an issue. Also, you can be receiving in terms of billions, and then you are spending in terms of billions, and you are spending even in a way it is not managed. That is, you are not managing your cash flow well. And when you look at Angela, most of the businesses which have failed, almost all of them trickles down. The failure trickles down to failure to manage money, to manage cash. And when we talk of cash, we talk of all the various forms in which are cash or cash equivalent was even money in bank, MPESA, the liquid cash. So you are getting an inflow, but there is also an outflow. So failure to manage that outflow was you may incur liabilities, you may incur expenditures which are far beyond the inflow you are expecting, and some even may lead to even the business being closed. Also, there is this bankruptcy and insolvency. Insolvency is basically an inability of a business to meet its obligation or its liabilities. And again, it trickles down to how cash is being managed, because it has reached a time you are expected to pay money, let's say loan, to repay loan, and then you don't have an equivalent or enough cash to pay. So they are fallen due, probably the first month, the second month, the third month. Then now, the person can take legal actions and the business can be liquidated. You remember, Angela, when you use even in the government perspective, was it at the beginning of last year or somewhere last year, Kenya was expected to default in terms of payment of its obligation, payment of the loans, which was due to the outside. according to what the government is saying, they were able to manage itself.
Yeah.
And they were able to pay.
Yeah.
In Africa, there were around 6 counties. So Kenya was one of them. And I think the others defaulted. So there are some repercussions of defaulting. It will affect now a future loan that you want to get there, because it will increase the loan servicing cost. You are supposed to get a loan at an interest of, let's say, 8%, but now you are getting at, let's say, 15%, because even your ability to pay, the possibility of you not repaying is very high, so they are charging you the interest, and that trickles down to you failure to manage your cash, among other perspective. So as per Robert Kiyosaki, that is good. That is, so failure, you may be having inflows, but you fail to manage the outflow, and that even outflow may be even as a result of corruption. It may be as a result of employees taking money from the business. Yes, you are receiving money, but now you are not managing the outflow. You fail if it's KRA issues. You fail to pay the liabilities, the taxes which are due. KRA issues, let's say agents notice, your accounts are closed, then that may affect the operation of the business. So cash flow, you have chosen a very good topic. Cash flow management is so very important, be it to an individual, be it to an SME, be it even to companies, be it even to government. Yeah. Okay,
so what I'm getting is a business can make more profit and get more money, and still, if they're struggling with cash flow, still there's a possibility they can shut down that business, right?
Yeah. Making more profits, and then you know the determination of profit or loss for a business, as per accounting principles, you are using the incomes you have earned. The incomes earned are the incomes probably you have provided services, or even you have sold goods. Whether you have received those the money for that, for the goods or the services, that will still be taken as part of sales. So like that example I was giving you, the simple examples of milk. You sold 20 liters of milk at let's say 100 shillings, but you sold on credit, and you purchased at, let's say, 1500. Whether you sold on credit, you have cash 2000, you still use that 2000, whether you have it or not, it was sold on credit.
It's a sale,
yeah, so it's a sale. So your profit will be 500, yet you don't have cash. And then now, if that sale you sold on credit, you fail to recover that amount, then because there are some reasons why a person may not repay. It could be even bankruptcy, insolvency, or even just a person disappearing to pay that amount. So you'll have made a profit, then now, and yet your business is collapsing because cash flow was not managed. You did not manage the receivable itself. So it could have been even possible if you are to sell on credit. Probably you can say, let me sell 5 liters on credit. I can sell 15 liters on cash. Say that if that person defaults in paying, that will not affect your business.
Okay.
Yeah.
And let's now address, that is the corporate managers and the mid-sized business. In a group with multiple that is currencies, how do they manage liquidity in a business?
Yeah. Thank you, Angela. What that is basically, we are now talking of cash inflow and outflow at a higher magnitude. So you fail to manage the inflows, where you could be receiving in multiple currencies, or even in you sold on credit, and yet there are some obligations which are due to be paid. Then failure to pay, then that will also affect the business. So Angela, be it an individual, be it a big company, that failure to manage that cash flow, because for now big institutions like corporates, probably they are now forced to use technology or even advanced mechanisms of managing the inflows and outflows, proper recording. I was telling you, if it's you as an individual, let's say you want to go to Nyahururu to spend a weekend, you can have it off it. You estimate your expenditure, you have your revenues, then you can have it off it. But now for big institutions, corporate, like even the government, they are talking about e-procurement. E-procurement, that becomes a component of managing cash, because they want to see what the government is purchasing. They want to see you have purchased, let's say, a pen at, let's say, 15 shillings, yet in the market is 5 shillings, that is still part of the management of the cash, because failure to manage that now as a government or as a big entity. And you know, for government and these big entities, they are using softwares. Like government, they are using what is known as IFMIS, Integrated Financial Management Information System, to manage the inflows and outflows versus what was budgeted and what was expected to be paid in a period. So whether it's an individual, whether it's a corporate or management of cash, it's basically you are looking at your inflows, you are looking at your outflows.
Okay.
Yeah.
And now let's talk about something that is working capital management, because it's connected to the cash flow management, right? And what does working capital mean in a business, and why is it that important?
Yeah, thank you. Angela, components of our working capital, you are looking at our current assets versus current liabilities. When we say current liabilities, those are liabilities or payments you are expected to pay within a shorter period. It could be even 3 months, 2 months, a month. Like you purchased your stock. If you are dealing with retail business or wholesale business, you purchase a stock from manufacturers worth, let's say, 5 million or even 50,000, you purchased on credit. So that becomes a payable, and it's a component, it's a current liability, because you are paying within a period or a shorter period. It could be even within 12 months or not more than 12 months, because if it goes more than 12 months, then it becomes a long-term liability. Then it's removed from current liabilities. So any obligation, any liability, any payment that you are expected to pay within 3 months or even within 12 months, that falls under current liability. Then now we have current assets, and current assets, components of current assets, we are looking at inventory, stock, the items you are dealing with. Then we have aside things like receivables. I was telling you, the items you sold on credit, so that amount due from your customers, that becomes part of receivable. So those components under current assets and current liabilities, managing that becomes a working capital. So if look at let's say receivables, so you may fail, you may have given goods on credit or services on credit, and the terms was to be paid, let's say, within 30 days or even 60 days. So remember, when you fail to follow up, that person, the debtor himself, may even fail to pay within that period, or they could have, the period has elapsed 90 days, now it's 100 days. So if you fail to follow up as to reason why they have failed to pay within that period, you may find yourself even continuing selling goods on credit to somebody whose payment ability has gone down. Somebody who could be facing his or her own challenges in terms of payment of liabilities. So you will be importing the challenges being faced by that person into your business. Because now your inflows will be affected. You sold goods on credit, but you have not followed up for the payment because that person has not paid within the period. So that has affected your inflow. So affecting your inflow, then now we have the, assuming on the other side, the outflows, the trade payables are so aggressive. It's not yet even time due to be paid, but now they are making calls. Make sure ECP iterate vile tulikuwa tumesema. So they are aggressive in terms of following up. Then you are not aggressive in terms of following up for your money. Then now that results in what we had mentioned initially, liquidity problem. Liquidity problem. You are now not able to meet the obligations, especially the current obligations, as they fall due. Here, KRA taxes, it could be paid, could be corporate tax, installment tax, which are supposed to be paid. The time to pay has reached, but because you have not managed your inflows, then it has affected the payment, resulting in further complications, because there are penalties, there are issues, credit rating being lowered. Being lowered means now when you go borrow again, you will borrow at high interest, and that brings even confusion to the business. Again, you may not be managing the cash that you already have, because you know, you could be having employees who may not be trustworthy, and because you have your money or even money in the bank or MPESA, but you are not managing it well, then that it gives them an opportunity to even use for their personal, and that will affect your business.
And you, in explanation, you've mentioned that is the assets and the ability. And what happens if the liabilities are more than the assets in a business? Does it affect cash flow management?
Yeah, thank you, Angela. Yeah. Liabilities, that is basically liabilities when it comes to payment, that will form part of outflow. Then assets, those are if you are to sell assets, or even some assets, they are the receivables, so that will bring inflows. So inflows in the aspect of assets, outflows in the aspect of liabilities. So if you are expected to pay more than what you have, then you are at risk. You are at risk of even being declared insolvent. And insolvent means for insolvent businesses which are fallen down as a result of that, not managing liquidity. It's basically a court of law, and when the creditor takes evidence that you are not able to pay, then the court of law will just look at your total liabilities versus your total assets. So if total liabilities are more, then you are insolvent. So when you are declared insolvent, then that business will have to be taken over. It could be taken over by receivers to manage to sell the assets. Because assuming you have assets worth 20 million, but the liabilities are 30 million, and there is no possibility unless you can justify that you are able to grow the 20 million to be able to pay the 30 million in future. So in that case, it becomes an issue
in the business.
Business.
And for someone managing stock or inventory, as you had mentioned, how do you prevent overstocking that traps your cash?
That is also another area which is a component of the working capital, because remember, when you are dealing with the business, you want to sell the stock, the items that you have purchased within the shortest time period, which is known as inventory conversion. There is something known as inventory conversion cycle, where you are looking at how long are your stock staying versus how long can you turn your stock into cash, or it could be even into receivables. So you want to manage in such a way, like for these big corporates, like manufacturing companies, like these supermarkets, these big ones, they have used technology where that technology, it's able to notify. It's able to notify person in charge that you are about to run out of this stock, or you have stocked these items, or the time if they had expiry period, then the system is able to notify that the items there are certain items which you purchase which they are about to expire. So if they cannot be sold within this period, then you are likely to have to dispose them, and it becomes a loss. So in that case, when they have such systems in place, I'm talking of big corporates, when they have that systems in place, then now you are able, if the items which are approaching towards our expiry period, then you can even, they can bring it in front. Like I'm looking at, I normally see at the supermarkets, the bread which were purchased, let's say 3 days ago, they are being arranged up on bail. So that you are likely to pick. If they are left behind, then they'll expire, because customers are picking what is in front. So that is now for big corporates. For individuals, if you are able to track your stock, you are dealing with few items, through even a recording, you purchase these items on such and such a day, and you want to convert that in the shortest. And one of the areas in which you can use to convert now that the stock, the sale on credit is still a technique. It's still a technique. Because you may say, I rather sell on credit, say that I have somebody to follow up to make that payment, rather than having this stock expiry period, or even staying in the business to a period which you may not know, or even at times you may be dealing with items which are almost running out of fashion. So you need to devise strategies. You can even have aggressive marketing. Say that now, discounts. That say that now you are able to manage your inventory, you are able to convert that inventory into cash within the shortest time possible. You have reduced the conversion cycle.
Because of viewers, in simple language, what does this term cash conversion mean? Yeah.
Is it cash conversion or a credit or a inventory conversion?
Yeah.
It could, yeah. Or we can just mention the two.
Yeah, the cash conversion.
The cash conversion.
Yeah.
Cash conversion, even by the time itself, you want to convert cash into, let's say, an item. Like Angela, I was mentioning about you having inflows. So let's say all of a sudden there is a kuna mahali umepata ka deal, say that money are coming in far beyond even what you had budgeted to pay. So now you will be forced now to think of ways to devise ways in which you want to use this money. And it could be even paying, forecasting, paying a liability you are supposed to pay, let's say a year or 2 years to come. Because now you have the cash and you want to manage what is coming in from. Or even you can decide to invest. Yeah. Instead of having your money lying in a bank, you can decide to invest, and they have various avenues to do short-term investment. There is with Sacco in Kenya, but Saccos in Kenya, there is a statutory amount they are supposed to save, to put it in a reserve. That amount to be put in a reserve, they are advised to do an investment of that amount instead of having the money lying in bank or in the business. That is conversion. You are turning cash into broadly other assets or even discharging liabilities which will to fall due in future, and that will give you more room in future probably when you will face challenges in terms of inflows. Yeah.
I love the way you help us understand that is how businesses can convert that is inventory and receivables into usable cash. And you have mentioned something to do with investments. When it comes to cash flow, what helps a business identify that they're in a position to invest their money somewhere without affecting their current financial position?
Yeah, thank you, Angela. Depending on a specific scenario or a case in particular, if all of a sudden you have more cash in the business, it could be in the bank, it could be the liquid cash or MPESA. So as a business, you may decide instead of having this money lying, you can invest. If it's a money that you may require, let's say probably in 2 months, 3 months, or within a year, you may decide to invest in short-term investment options. And that gives us a topic which we can discuss in future, the various investment options. Because you can decide to invest in money markets. You can even fix the money in a bank account where you agree with the bank. I want to have this money fixed for, let's say, 2 months or 3 months because I don't see I'm using it within that period. Or if it's long term, there's an inflow, a huge inflow of cash which you may not require, let's say, within the next 12 months. You may decide to say, let me invest in a more long-term investment options. Or even if we had budgeted to, let's say, purchase a motor vehicle or an asset, let's say we are in October.
Yeah.
We are in October. You had said we had planned to purchase a motor vehicle or an asset in December. You may decide now, instead of waiting for December, let me purchase it now because at least I have a huge inflow which I don't need to wait until December for me to purchase. So it's, you look at that huge inflows in a very big perspective. It could be long-term investment, it could be now investment in short-term, it could be even paying liabilities which are to fall due in the near future because that you are using it to manage. You know, Angela, you have huge inflow now. So instead of waiting, let's say, too much to pay off a loan or a debt, then you can now discharge it now, so that when it reaches that period, you will be free to do other things. Yeah.
And because our time is up, let me wind up before you put a pen. How do you balance that is reinvesting in the business and keeping a safety buffer, in simple words?
Yeah, reinvesting.
Yeah, in the business.
So basically, you want to balance. Because again, when you do an investment, Angela, let's say you have invested in long-term options. That long-term options, when that money will mature, if you don't balance well, then you may have invested in long-term for something which was supposed to be short-term. Say that within, let's say, a month or 2 months, now the inflows has been affected. It does not come the way it came initially. And because that investment option you had opted for is long term, you are not able to recover your money until the maturity period. So you look at that, even as you reinvest that money, are you reinvesting in a way you will recover within a short period to match with outflows? Or are you likely to have an outflow in the near future? So that even as you think of that reinvesting, how will I pay off this, let's say, a debt which falls due in December, and yet you have invested to mature in, let's say, August next year. So it's a balancing act that you as a business person, you need to match it well.
Wow, that was very wise. For our viewers, I believe that you have learned a lot when it comes to cash flow management, and so we have learned a lot, and we are honored to have Heidi today in the show. Thank you so much. And because of time, you can share your number. Those who are interested when it comes to financial consulting, watakutafuta.
Oh,
yeah.
Thank you, Angela. Yeah, I work with an audit company known as Bond and Drew, where we do tax consultancy. We do auditing and then accounting. So my number is 0723 46 70 20.
Okay.
Yeah.
I'm sure watakutafuta. For our viewers, thank you so much for tuning in for this show that is Money Monday, your go-to show for financial tips. Whether you're a business person aspiring to have your own, you're a day-to-day person aspiring to have this great business or become this great entrepreneur, you're an entrepreneur and you're looking for better ways and smart ways to make sure that your business grows each and every day, well, this is the right place where we give you the strategies and help you become financially independent in the future. I believe we have learned a lot when it comes to cash flow management, and come on, we tune in, you can go back to that is our social media handles on Facebook and YouTube at Mizpah TV Kenya. Watch, and also don't forget to leave a comment and tell us what have you learned. My name is Angela Kabete. Till next time, may God bless you abundantly. Bye bye.